A bombshell government report just unleashed an economic earthquake, one that exposes Trump's nightmare scenario and is about to impact every worker all across the country. Plus, we have a sponsor of today's show. I'd like to welcome immunopriced antibodies back. You can find them on the NASDAQ under symbol IPA, and they're pioneering the future of medicine with AI-driven innovation. And the last time we featured IPA, its stock rallied 15% intraday. You don't want to miss out again. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg, where we picked today's story up with a headline: as U.S. core inflation rises less than forecast for the fourth straight month. And on the headline, this is the relief that workers have been looking for. But what they don't realize, and what the Trump administration doesn't realize, is what we're seeing in the inflation report today is setting up a nightmare scenario, one that could plunge the U.S. economy right into a recession. The Consumer Price Index, excluding the often volatile food and energy categories, increased 0.1% from April. From a year ago, it remained fairly steady right around 2.8%. So what we're seeing right now in the reports is that the cure for inflation has been higher prices. The challenge is prices haven't gone up that much. So the real cure? Well, it's shrinking paychecks relative to inflation. And based on what we're seeing in the report, what you're about to find out is pay growth is about to shrink in a major way. But the CPI showed only limited signs of increases driven by tariffs, despite the fact that experts, executives, and even Democrats said, look, inflation was going to skyrocket. But look at this. The Consumer Price Index continues its downward trend. Stripping out food and energy, also on a downward trend. Services less energy, also headed down. In fact, the only driver of inflation that we see from these charts is commodities. But there was something else in the report that was absolutely shocking, and what it showed was actual deflation. I'll show you that in a moment, because on the headline, again, the CPI only rose 0.1%, year over year only 2.4%, despite the fact that, again, many people said this was going higher, perhaps because the most punitive levies have temporarily been on pause, or thanks to companies so far absorbing the extra cuts, or perhaps even boosting inventory ahead of tariffs. We could also say it has to do to a lack of consumer demand, as we see consumers reject higher prices because their paychecks aren't keeping up with inflation. But what you're seeing here in the report is setting up the nightmare scenario, and it starts with, of course, discretionary spending dropping. Now, how do we know that's happening? Because we look at food and energy inflation. We see that's driving the main part of the report, and as those go higher, that means consumers have less money to spend on the discretionary side of the economy. But what's shocking about this report is if we strip out shelter inflation, which is largely an estimate by the Bureau of Labor Statistics, what we find out over the past 3 months is we're not seeing inflation, we're actually seeing deflation. But something we think could head a lot higher, that's the stock for our sponsor for today's show, immunopriced antibodies. Again, you can find them on the NASDAQ on symbol IPA. And let's take a look at their recent chart here over the last 30 days, because right now, based on the technical indicators, it's in oversold territory, and it's been holding on to its 30-day volume profile, setting up what could be a huge move higher. Stay tuned to the end of the show, or again, check out the pinned comment or description for more information. Because the risk is that consumers who are still reeling from years of elevated inflation in the aftermath of the pandemic will only tolerate so much and eventually pull back spending. And see, the notion here that it's tolerate higher prices. Now, in reality, consumers don't mind if prices go up as long as their wages are going up at least at an equivalent rate or even faster. And that's the real issue here, because everybody believes, including the Federal Reserve, that we need to bring inflation down. What they don't realize is when you bring inflation down, you bring demand down, and when demand comes down, well, pay growth falls, and then next thing you know, you start to see the unemployment rate rise. Because let's talk about the impact of wage growth on the Consumer Price Index and why we're setting up for a nightmare scenario. As we look at the Consumer Price Index in blue against average weekly hours of production and non-supervisory employees, and when we go back through every cycle, we see going into recession, inflation, you see in blue rising, at the same time you see hours worked declining. And every time you see that scenario, you either get a pullback in the economy, as we saw in 1994, which was considered a soft landing, or you start to set up a move going into a recession. We see it happen in 91. We see it in 2001. We see it in 08. We see pullbacks around 2013. We see it happen again in 2019. And now we're headed in the same direction. Many people, again, say inflation only goes higher. But when you look at average weekly hours that we know are likely to turn down here, what it suggests is that inflation is going lower. And this is a major problem because we do know there's going to be some sort of impact of prices from the tariffs. But it's not just that. It's the impact it's going to have on corporate profits, on the equity markets, and again, on wage growth, all set to perhaps fall. The impacts of pandemic-era government spending and monetary policy that helped support the U.S. economy have faded, and that makes the country vulnerable to a downturn in the coming months, as according to J.P. Morgan Chase CEO Jamie Dimon. I think there's a real chance the real numbers will deteriorate soon. Now, I agree completely with that statement. Now, I want to know from you, do you think the real numbers are about to go plunging down? Do you think the economy turns around, or does it stay about the same? Weigh in the comments below, because the reality of the situation is it's all about work. And the nightmare scenario here is if inflation continues to cool off, there's a problem. We're going to see corporate profits shrink and even contract. We're going to see wage growth slow. And at the same time, we're going to find out that workers cannot afford prices where they're at today. It doesn't matter if they go up because they're going to see their paychecks continue to shrink. Employment will come down a little bit, Dimon says. Inflation will go up a little bit. Hopefully, it's just a little bit, noting that what we could find out is that if employment starts to unwind, that inflation is not going to be our problem. What it means is we're going to be headed right into recession. And that is the nightmare scenario because we look at what it takes to get out of that. And once you start to see the unemployment rate start to spiral higher, it's game over. There's no way out of this scenario. In addition, declines in travel-related categories, recreational services, including admission to sporting events, also declined, a sign of pullback in discretionary spending. And this is exactly what we warned would happen. If we see, again, any signs that food prices go up, energy prices, or in this case, rent, whether the number's made up or not, it doesn't matter. As long as it's impacting consumer wallets, it means they're going to spend less money on the discretionary side of the economy. Now we're seeing that. So what does that mean for a lot of those workers? Well, the first thing that's going to happen, again, their hours are going to get cut. And then next thing you know, it's all about jobs. And this starts to make sense as we see confidence plunging because workers know what's coming. They can see it. It's going to show up in the data. Let's take a look at the University of Michigan Consumer Sentiment Survey in blue and overlay average weekly hours of production and non-supervisory employees in red. And you can see consumer confidence has everything to do with paychecks. As hours go up and down, you see confidence goes right in line. And what we saw at the last report from University of Michigan is confidence tumbled and went straight down back to where it was in 2022. And it's a warning sign because what workers are saying is they're running out of work. They can see demand going down. They know that means their hours are going to get cut. That means their paychecks are going to shrink. And it doesn't matter if inflation goes higher because their spending is going to go down. And the moment we start to see spending drop off, well, what we are facing then, again, it's a nightmare scenario, one that points us right into a stagflationary recession. And central bankers also pay close attention to wage growth, even though I'm going to show you it makes absolutely no difference, as it can help inform expectations for consumer spending, the main engine of the economy. A separate report Wednesday that combines the inflation figures with recent wage data showed real, or inflation-adjusted, average hourly earnings climbed 1.4% from the year before. So according to government officials, everything's okay. Everyone should be able to afford higher prices. The problem is they're not looking at weekly hours. We see that's on the decline. But for those hoping to see further wage gains, well, the CPI says that's going to go away and fast. Let's take a look at the relationship between the Consumer Price Index and average hourly earnings for production and non-supervisory employees. That's shown in red, and you can see the relative consistent relationship between the two. And right now, everyone, again, wants consumer prices to go down. There's fear that the tariffs will drive them higher, but so far, no signs that will happen. But at the same time, everybody wants their employer to give out bigger raises, and based on the relationship, what it means is people are going to still get raises. They're going to be far smaller, and due to the impact of tariffs and the fact that businesses can't pass that on to consumers or to their employees in terms of higher wages, well, what it means is we're going to see average hourly earnings come plunging down, hours worked are going to drop, paychecks are going to shrink, and if inflation, even if it does come down, it's not going to come down fast enough, and as you can see, it's all setting the stage for the nightmare scenario. And it's starting to show up in the equity markets as Smucker falls the most in nearly 40 years if tariffs hit profits. And many people want companies to absorb them, and they're going to say that right until it hits their 401k. Shares sank 16% on Tuesday, the biggest drop in data going back to 1988. And that's one of the risks we're facing going forward, particularly as we head into earnings season. We could find out that a lot of companies are going to face a squeeze at the margin. They're going to eventually have to cut employees to bring their profit margin back up. But in the meantime, it could have a major impact on their stock price. Let's take a look at this next chart of corporate profits after tax in blue against the NASDAQ 100 in red. And you can see both of them on a year-over-year rate of change. The expectation from investors is the stock market goes higher. But if corporate profits roll over and head negative, watch out, the equity markets could follow. So as you're seeing now that the nightmare scenario isn't just about the labor market. It's not just about people losing their jobs or seeing their pay growth shrink relative to inflation. It also has to do with their net worth. We could see, of course, this trade war, this slowdown in the economy impact people's 401k and retirement in a major way. And that's why I said the other day there would be a push to get this trade deal done, particularly with China, as Trump now says China will supply rare earth in a, quote, done trade deal. Our deal with China is done, subject to final approval with President Xi and me. We're getting a total of 55% in tariffs. China's getting 10%. Relationship is excellent, although that is a problem because it does indicate that at some level prices here have to go up. We know companies are going to continue to try to absorb what they can, but there's only so much. And that's a major problem here because, again, you think about it, as we see hours worked go down and pay growth fall, what it means is workers can't afford prices today, let alone if they were to go up. And under the pact, U.S. Commerce Secretary Howard Lutnick said Tuesday that China pledged to speed up shipments of rare earth critical to U.S. auto and defense firms. And we've talked about this in a previous show because we found out there are a lot of manufacturers that rely on these and they were running out of inventory. The impact would be without rare earths, it could shut down entire industries. We know that's why the Trump administration was eager to get this deal done. The same for China because they need things from the U.S. While Washington would ease some of his own export controls, Trump indicated that he believes that Beijing would have to make the first move. And well, right now it appears to be the case. The question is, will those rare earths show up on U.S. shores? We'll find out soon enough. In a later post, Trump said she and he are going to work closely together to open up China to American trade. That would be a great win for both countries. Arguably, China liked the existing deal that they had now, but for the United States, opening up China to our producers, to our manufacturers, to our farmers would be great for our economy. And what we're finding out, though, is there's another problem that's going to face U.S. consumers, one that could really drive prices higher. It's all about energy. As oil prices rally as Trump doubts Iran talks and sees China deal as done. And this is a problem because when we look at the consumer price index relative to the price of gasoline, as we look at U.S. regular all formations gas price in red, you can see the strong relationship between the two. The challenge is if we were to see gas prices go higher, what it would do is push the consumer price index up at the same time. What are we facing? Slower wage growth. We're also facing fewer hours and the potential that even with a 55% tariff, we're going to likely see prices go higher. The risk now to the U.S. economy is high. It's setting up a nightmare scenario for the Trump administration and for workers all over the country. But something we're bullish on is the stock for our sponsor for today's show, Immunoprice Antibodies. You can find them on the NASDAQ under the symbol IPA. And they're pioneering the future of medicine with AI-driven innovation. And keep in mind, the last time we featured IPA, its stock rallied 15% intraday. This is one you don't want to miss out on. Everything you need to know in the pinned comment and the description below. Immunoprice Antibodies has achieved a landmark breakthrough identifying a universal target for dengue vaccine using its AI-powered LensAI platform. This discovery, pinpointing a conserved epitope across all 4 dengue stereotypes, positions IPA at the forefront of computational vaccinology. With dengue affecting millions globally, IPA's innovation could transform vaccine development and address a critical public health need. And IPA's LensAI platform delivers X-ray level epitope mapping insights in mere hours, matching the accuracy of traditional methods with unmatched speed. This advancement slashes costs and timelines for drug discovery, empowering biotech partners to accelerate life-saving therapies. By redefining efficiency, IPA is setting a new standard in AI-driven biotherapeutics. And Immunoprice is leading the charge in ethical drug development, aligning its Lens AI platform with the FDA's move toward non-animal testing methods. By predicting toxicities and immune responses in silico, IPA reduces reliance on animal models while enhancing precision and safety. This forward-thinking approach positions IPA as a trailblazer in regulatory compliant, humane innovation. And IPA secured a strategic $8 to $10 million partnership with a global biotech leader to develop cutting-edge cancer therapeutics, including antibody drug conjugates and biospecific antibodies. By combining its Lens AI technology with its proprietary B-Cell Select platform, IPA is driving the next generation of targeted cancer treatments. This collaboration underscores IPA's growing influence in addressing unmet medical needs. Now let's take a look at that chart setup we looked at earlier, and you can see right now, based on the RSI and the MACD, that IPA is trading in oversold territory. And we know from a technical perspective that oversold conditions can turn around price in a major way. And we can look back to the last time it was oversold condition, and we saw the stock skyrocket. Right now, it's holding its 30-day volume profile as buyers stepped in today, setting up a potential move higher in IPA. And again, keep in mind, the last time we featured them on the show, the following day during intraday trading, the stock rallied 15%. And Immunoprice Antibodies is revolutionizing biotherapeutics with AI-driven precision and strategic partnerships. Learn more about their vision to transform healthcare at ipatherapeutics.com and on the NASDAQ under the symbol IPA. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.